So Piketty's Capital in the 21st Century deals primarily with the issue of inequality. Piketty argues that capitalism will always necessarily result in inequality, and his argument for reversing that inequality is through state intervention. Of course, Thomas Piketty analyzes this inequality from a macroeconomic perspective rather than a microeconomic perspective, and furthermore, he uses mathematical modeling to back up his arguments. So Piketty uses one formula primarily to reinforce this idea about inequality. So he argues that basically when the rate of growth is really low, the return on capital will result in more than the income or output. So this is how he derives this formula: R is greater than G, where R is profits, dividends, interest, rents, and other income from capital, and G is the economic income or the output. Basically, he's arguing that whenever you have a low economic growth, then the rate of return on capital will always exceed the rate of return from labor. So basically, if you have capital or wealth, basically, then even though you are not necessarily putting it out as much labor, you are definitely having greater returns. So this is how we get this divergence between the wealthy and the poor, because the wealthy tend to have greater amounts of capital, and so they have much larger returns than the rate of economic growth. Piketty also talks about inheritance. Now, he uses a very similar argument for inheritance as for the divergence of wealth in the last slide. Basically, that wealth inequality will be increased as long as R is greater than G, and it will become more divergent the greater R is than G. So basically, this is the same case as an inheritance. Although you may not have necessarily greater amounts of capital, that inheritance will allow you to invest or use your money on capital-based goods rather than through labor, and that inheritance will actually result in a greater amount of wealth for you as an individual rather than if you were to be a working person. So the Austrian economist really hinges on three important aspects of macroeconomic thinking. Basically, macroeconomic thinking is not viable because of the importance of the individual. So for an Austrian economist, individuals are the ones that are making all of the decisions in the marketplace. And so an Austrian doesn't really understand why we would be analyzing from the macroeconomic perspective anyway, since the majority of our information is actually about individuals. Furthermore, since individual tastes and preferences are changing so quickly, it doesn't make sense to actually look at them on an aggregate scale, because we actually lose a lot of information when we aggregate. Secondly, Austrian economists believe that price establishes order. So basically that whenever you have certain price levels, that demonstrates to both producers and consumers the value of whatever that good is. So say you have a really high-priced good, that's a signal to producers that they can make a lot of money by producing that good, and so greater production of a good will occur, and then the price will lower, which may incentivize consumers to purchase more of that good, and constantly that price is establishing a greater amount of order and basically demonstrates to both producers and consumers the relative value of any given good. Finally, because price does establish order, the Austrian economist believes that there should be limited government. Now, this kind of makes sense when you think about it from the perspective of the Austrian, because as long as price is establishing that order, any sort of governmental intervention will actually reduce the amount of order that can be established. So whenever we have some sort of government intervention, say through taxes, it will actually disrupt and cause disorder in our economic system so that we're not actually sure of what's going on in the marketplace. So the Austrian critique of Piketty's book is basically that everything with Piketty's thesis is wrong. First, of course, since Piketty is analyzing this from the macroeconomic perspective, an Austrian would be very critical of that approach, simply because if we aggregate any information, it leaves a lot of information that isn't accounted for, or information that is lost through that aggregation process. So the Austrian would be really hesitant at looking at wealth not only on a countrywide scale but on a global scale, and analyzing inequality through that measure. An Austrian would be very suspicious of that method. Secondly, Piketty's reliance on the R is greater than G formula relies on mathematical modeling, which again Austrians are not particularly fond of, simply because whenever you use mathematical modeling, you basically have to throw away the assumption that an individual's tastes and preferences are ever changing. So mathematical modeling for an Austrian is a questionable practice. And finally, Piketty's argument that the state should intervene in the economy to prevent inequality from occurring. Piketty argues, for example, that the wealthiest 1% should be taxed at an 80% rate. An Austrian would disagree with this. Austrians want as hands-off a government as possible, and they would probably argue that by increasing the amount of taxes for the wealthy, it would rather incentivize someone to, say, earn $490,000 a year rather than $500,000. So basically, whenever you introduce some sort of state intervention, you're actually making it more difficult to control those factors of the economy that you actually set out to control. So there will always be ways around it, and it will just result in the economic process becoming more and more overly complicated. So basically, the Austrians, again, believe that we should have a tax-free, laissez-faire, liberal economic policy as possible, because this is what's going to allow that price system to really establish what we value. And of course, inheritance is a very hot button issue for not only Austrians, but for economists in general. And the Austrian perspective is somewhat hostile to Piketty's approach. This is simply because whenever we rely on state intervention to help our economy do better or to minimize inequality, then we are intervening in the government in a way that may not be helpful, because we don't know what hurdles this will introduce. So an Austrian would rather argue that even if inequality is a result of capitalism, which I don't think any Austrian would argue, but if they were to argue that inequality was a result of the capitalistic system, it would be because there's only halfway state intervention at this point. So we have some laws that will help the wealthy stay wealthy, and if we were to get rid of all state interventions, an Austrian would argue that actually there would be no inequality, and the elimination of governmental intervention would actually result in a more robust society, and that any sort of inequality that is emerging is a result of those state interventions that are already in place. So basically, the end result is that we have Carl Menger here on the bottom fighting with Thomas Piketty, and they simply offer two extremely different approaches to the issue of inequality, and not only inequality, but economics in general, that it's hard to say whether or not either of them is really directly speaking to one or the other, because they simply are in such great conflict philosophically with one another. So it's an interesting book, especially when analyzed from the Austrian perspective, because the two perspectives are so divergent that they're almost unrelatable.